Welcome, welcome. How we doing? Welcome, welcome. We'll give it a few more minutes here and see what's going on. How's everybody doing? Hope we all had a good day. Kind of a funny one in the market, but we had a couple fun ones. I might be having some microphone issues. Maybe.
Hear you
Can you
now.
guys hear me? Can you guys hear me? I heard
Yeah.
you. Yeah, good deal.
All right.
We good. Good.
Cool.
Welcome, welcome. How's everybody doing? Yeah, we'll just give it a couple more minutes. They did bring us to an interesting spot in the market here. Wonder if we're gonna have a big day tomorrow or not. Oh yeah, absolutely, because that's part of the trade plan. Definitely a big part of trade plans is trading psychology. That goes along with it in a real big way. And so we're definitely gonna touch on that a little bit. We're in fact kind of going to start with a little bit of the trading psychology stuff, and then we'll lead into actually building some trade plans, and then we're going to use a trade that we took today in the voice chat. Unfortunately, I didn't capitalize on it as much as I could have, but still gives a nice little scalp and uh, just show people what I was looking at. Of course, kind of a simplified version of what I was looking at. A lot of the time in these classes. Actually, let me make one more post. Give me one second. So a lot of the time in these classes, what I was saying, or I guess we'll just get started. Welcome everybody. How we doing? Hope everybody's good. Had a good day. Dirty River here. Tonight we are going to be talking building trade plans. And what I was just saying was, uh, a big part, and I had a question about it, a big part of building a trade plan is trading psychology. And so if you if you don't have good trading psychology, or at least have your trading psychology under control, you'll have a very difficult time, trading your plan or managing your trades properly. And of course, uh, you know, how you treat a same day, you kind of treat them, of course, a little bit differently than another trade. But you always need to follow your plan. And so, obviously, if you're going to follow your plan, you have to have halfway decent trading psychology. And so, with that, again, we'll get started here. Dirty River, thanks for being here. We've been leaving the microphones unmuted for a couple months now, seems to be working. As always, I want to encourage you to, if you have any questions or I go too fast on something, stop me and ask a question. That's what all these classes are for. As most of you guys know, I trade in a really simple way, a way that most people can understand, and most people can at least find some amount of profitability as long as you're following your rules, respecting your risk, doing all of those things, the outside part of trading. I can teach you how to trade a chart. And I can teach you how to build a plan around that chart. But teaching people to follow their rules is where it gets really, really difficult. And so, something that I always teach is a trade plan consists of three different things. And to me, the three different things, the most important parts of any trade plan, and in this order. I really want to emphasize that in this order. Most important part of any trade plan is going to be your entry. You need to know where you want to buy that trade. I have a good friend of mine. We joke around a lot, and she's always been a good sport, but she has a little bit of an issue. She's fixed it. We joke, we call it ECE, every candle entry. A lot of people have this thing, and I deal with it a lot in voice chat of people saying, "Hey, what do you think of this trade? What do you think of that trade?" And oftentimes my answer is no. I will always try to say, hey, not, uh, not that your trade is bad, but that I won't enter that trade because it doesn't line up with my chart. Not to say it won't work for you. There's been a million times where somebody said, "What do you think of this trade?" And that I said no, and that trade ended up paying. That doesn't mean anything. It just means that I can't build a good trade plan around it. And because I think entry is the most important part, that's where I think people really struggle the most. They go looking for those every candle entries. They think every candle of the chart, every 5 minute candle of the day is providing an entry or a dip to buy or a short to rip, when in reality, you are almost always better just waiting and letting the trade build itself. We're going to do kind of two trades today. One of them that I took, one of them that we simply discussed and then unfortunately didn't end up taking. But just to kind of show you what our thought process would have been during these trades. So then entry, again, most important thing. Second most important part is going to be your stop loss. Basically the number one DM that I get from people is, "I'm down this bad. Should I stop out? I'm down 60%. Should I stop out?" It's always a really difficult question to answer because I can look at a chart and I can give you my opinion of it. And as I've said, I can be wrong. Everybody is wrong sometimes when they are trading. And so I hate to have somebody come to me. Well, of course, I don't hate you coming to me and asking for advice. It's what I'm here for. But I hate it when somebody comes to me. And to me, the obvious answer is cut your trade, move on. But we know how people get in here. Sometimes they got the whole dang port in there and they're down 60% on the port. So I always try to be very cautious, just saying, "Hey, cut that trade." Especially when we see it all the time. People are cutting trades oftentimes when they should either, they should likely be entering a trade. They're stopping out where the better entry was. We see that all the time. And so that's the second most important part. Stop out. You need to know your stop out to know your risk. So if we'll just open SPY just for no reason, because it's here. You buy this dip. your target is this SMA, and you say, well, I'm going to stop out under here. I'm just using completely random things. In no way do I recommend a trade like this. And you're going to see why. So you buy 635.15, you're basically targeting 635.80. So you got 65 cents of potential reward. Well, you say your stop is under here. Well, at 635.15, your stop is 634.20. You have slightly more risk on the trade than you have potential reward. Right there, you know, based on that entry, that trade is likely not worth taking because the risk reward's just not there. If you're always taking one-to-one risk reward trades, you just need to be right a lot. And you have to think, if you're only taking one-to-one risk reward trades, then if you take a stop out, that means you have to take a whole nother trade that plays out at the one-to-one risk reward just to cover the loss from the first trade. So for every one loss you take, you basically need to take two trades just to get back to a little bit of profit. So always have that good risk reward. And the only way to know your risk reward is knowing your entry and knowing your stop out. If you don't know your stop out, you don't even know how much money you're risking in the trade. There's times where maybe your stop loss is very tight. So you can have a slightly larger position as long as you respect your rules. You can have a slightly larger position because you're still only risking a small amount of money. Or maybe your stop loss is pretty wide. And so you're going to size down that position so that the contracts can, breathe a little bit more. I, of course, rarely trade that way. I think tight stops save ports. But then number three is your take profit, you know? And who cares? Your take profit is only so important. If you're green, if you're making money, you're beating the odds. You're we're going to get into managing trades that you're in. I get asked a lot, how do you hold trades longer? Obviously, we're going to touch on that a little bit. Once you're in and you're green and you're happy, you start trimming at any, reasonable support resistance, wherever your target is. If you do buy this dip and you get this bounce to this SMA, you better start trimming. That was your target. Maybe the next SMA is your next target, but this big old candle comes down, you likely should have been stopping out of a nice green trade in profit on a trade like this. Did it end up going? Sure. But you aren't here to impress anybody. You aren't here to, post in gains tab. Don't get me wrong. I know everybody appreciates it when they post in gains tab, Nando and those guys, they love it. I don't mind. Hey, if you tag me in gains tab, thanks. But I'm just happy you made money. That's all I care about. We're here to make money. Nobody needs to know how much money you're making. Nobody needs to know any of that. You're here to learn to trade. And so your take profits, make them reasonable and respect those take profits. The longer you trade, the more and more money you will leave on the table. I laugh about it all the time. Like we leave huge trades on the table every single day. That's just part of trading. We made money. That's all we care about. So as long as you know your entry, as long as you know your stop out, you're like 80% of the way there. Take profits, those are easy. You take profit where the chart tells you to take profit. Those are a piece of cake. You need to be respecting your entries and your stop outs. And then the final note on that, and this is, I'm sure, anybody who comes to my classes, anybody who trades in, voice chat with me or has talked to me on Trade4, you have likely all heard this phrase. I say it all the time. A good entry can turn a good trade into an absolutely great trade. It can also keep a bad trade not too bad, the planned level of bad. So the better your entry, the lower your risk and the higher your reward, always. And so that is where building a trade plan comes into play. As I said, we're going to discuss some trades that I took. Or one trade I took, one trade that we identified, ended up not taking. And then we're going to talk about individual names because we'll touch on it a little bit at towards the end. Trade plans on SPY, QQQ, same days, things like that, those need to be handled differently than what we are discussing today. Even today, it's Thursday, it's my favorite day to trade personally because the weekly contracts on the individual names are getting cheap, but are not as volatile and wild as Friday. We still got 2 days of trading on those things when we're trading them today. So I love trading Thursdays. So today, again, we're going to talk about how do I build a trade plan? What are things that I look for, and how do I get to that point where I want to actually take the entry, and where do I personally think that the entry is valid? And so we're going to start with charting. You know, uh, we're going to start with charting. This isn't a charting lecture, so I'm going to cruise through it. You guys are going to see how I chart support and resistance, take note of any trends, anything like that. And then as we come into the day, people ask me all the time, what time frames do I watch all day? And it's basically the 5 and the 15. I don't have anything against longer time frames. I do all of my charting on the daily. So when I'm watching the 5 and the 15 minute, I know that when the candles are coming in contact with the levels that I have, they're daily levels. So they're stronger support and resistance. They're levels that you leave on your chart for a long time. Honestly, you never delete them unless you get too crowded. And so that's my way of watching the daily time frames, kind of having an idea of where we are big picture without having to have the daily time frame up, and being able to use, the 5 and the 15 minute for, as I said, more accurate entries, stop outs, all of that stuff. So what do I do? As with any chart, first thing I'm going to do is support and resistance. I do it, different than some people do. I care about major highs and major lows in trending action. I also care about highs and lows of ranges. I think a lot of people try to say, oh, you need X amount of touches or whatever it is on a support and resistance level for it to be important. I don't care about any of that. I've never found a need for any of that. What I care about is places where dramatic reactions happened. For example, a big sell off here, followed by a big bounce. Was there news involved? Probably. Who cares? We only care about where did these big reactions come? Where did these big reactions come? And when you get one big reaction there, you oftentimes can get another big reaction. So we can see this one acted as some nice resistance, broke below it and dumped it, bought us right back up to it, strong resistance, sell us right back down. So we know this was a very strong little range right here. We've just marked the major highs and lows where those bounces were, and then we'll get a couple of these more recent ones. And then really the only other one I care about is somewhere right around here. So obviously, a lot of the market, a lot of those tech names are kind of starting to look a little bit tenuous on some of these things on the back of some of these earnings. We have gap downs, we have pushes back up, we're setting higher lows. Well, that doesn't matter. And this comment might come back to bite me, is and has the price action been getting a bit more bearish the last few weeks? Absolutely. I mean, I've been saying it. And so, we are still undoubtedly in a nice dip buyer's market. We just want to look for some slightly more substantial dips to buy. So for anybody who was in voice chat with me this morning, you guys all heard me right off the open. Amazon was what I was targeting. Amazon was what I wanted to trade. And it was, at least to me, one that I thought had some potential to put in a nice bounce. A lot of the other tech names were already bouncing ahead of it while it was selling. So I have my support and resistance levels. As I said, since I'm always charting the daily, I don't, you know, I open my screen and my levels are there. I'm ready to trade. I always glance at the daily time frame to again get my bearings of where I am. And so I looked at Amazon. I had looked at us selling down, small gap down on it even this morning. And I said to myself, hey, I likely want to be a bit of a dip buyer here if we can get down to basically this 219, 220 range. This is what I was discussing with people. Was somewhere in this 219, 220 range. Even that low a day yesterday is what we were talking. And the move that I actually wanted was back up to this 50 EMA, or SMA rather. I didn't get that move, but I'll show you what we did. We come into the 5 minute time frame, and we know where I want to be a dip buyer between 219 and 220. So what we have to do here is we have to end up looking left. So obviously you guys know the indicators I use. This is what my chart was actually going to look like on this day. We have hourly 20 going down. We have VWAP dramatically down. We're trading below the VWAP and the hourly 20. So I'm still watching Amazon. I'm watching it for a bounce. I know that my 50 EMA is sitting up there at 220.50 or whatever it was. And I knew I wanted to be a dip buyer somewhere down here around 219, 220, or the low of yesterday. So while this isn't necessarily a level I would put on my chart, I'm going to put it up here so we can see it. So we know that we want to be a dip buyer somewhere in this range. So we start looking for a reason to buy the dip. And we're watching it and we're watching it. And we finally get this nice sell down, push below here, push us closer to this support level where we say, okay, I want to be involved in this trade. And so we get the nice push down and uh, we buy. You know, we've seen this, or this is our push down. We see this nice move down and we end up buying. And so we analyze this really quickly. We're buying right around 220.90, 220.80. You know, we did fill somewhere down on this wick. Maybe it was even on this buy down, you know, somewhere right down here. And we know that our stop is going to be under 220.2. We also know our major target is 222.50. So we got $1.60 of upside for, you know, 50, 60 cents of downside. Perfectly happy with the risk reward on this trade. Well, you can see what happened. We bought somewhere here and we caught the ripper right on up. So we trimmed, you know, we catch the basically dollar move straight vertical. We trimmed. I unfortunately made the mistake. I won't say it's even a mistake. I don't care. I knew my plan. I knew my risk reward. I liked my 1 to 3 risk reward. I was perfectly happy to take this trade. I bumped my stop up. This wick got me stopped out. And, you know, ultimately it did run directly to our target. However, we knew all of the risk here. The contracts we were trading were relatively cheap. I don't remember what they cost off the top of my head. And dollar risk on it was going to be about $10. To the maximum risk reward was going to be, or the maximum reward was going to be around $45. So perfectly reasonable trade. It was very, you know, everything about this was controlled. It feels very weird to be buying on, you know, buying on these knives. While a bunch of people are talking about, I was even asked, don't you want to short Amazon? Looks like they're selling. No, we just have to always think big picture. Say they ripped us off of here before. So we know at the very least what I tell anybody when you're building a trade plan, you always want to say, you look at both sides. This is what I always try to encourage people to do. Why do I want to buy calls here? Why might other people want to buy puts here? When I look at something like this, you know, and this is just this chart today. When I look at something like this, where buyers keep showing up and keep showing up and keep showing up, they showed up massively the day before, ripped it $5 or whatever it was, $4 or whatever it was. We look at this and say, I know where I do not want to be short. I can see a lot of reasons to buy the dip right here with a tight stop. You know, a little 40-cent stop below these wicks. Plenty of reasons to be a dip buyer here. There was plenty of reasons end of day to be a dip buyer as well. And so we know everything here. We know that buying favors the bulls here. Do we have any interest in buying any of these? No, this is no man's land. This is that 50 EMA. We aren't trying to catch a breakout. We still want to be realistic, understand on the big picture, the trend is still down. We're trying to catch nothing more than a technical bounce. And so again, again, as I mentioned, let's see. 50 EMA, wherever it was, 222.14 or whatever. That was really going to be the target, 222.20. As I said, I didn't hold it, but you can see as we got up here to the 222.20, apparently other people felt comfortable selling there as well. Could you have maybe taken the short there? Yes, but it's the only reason you have to be short, so I wouldn't take that trade. Whereas over here, I look and I say, hey, you know, we're at least on my other chart, we're extended below VWAP, we're extended below the EMAs, we're setting a big double bottom from the day before. My stop is very tight. They're buying other names in tech. Amazon is the one with the most room to catch up, so we can put on this trade. Oh, I see. I got a question here. 1 second. So yeah, this absolutely everything that I've said applies to shares, it applies to anything. You know, don't get me wrong, shares are everybody always wants to rush into share purchases, share trades. You know, we're seeing it right now. Market's absolutely rallying, you know, has been for a while. to me, this isn't the time to be buying leaps. This isn't the time to be buying shares. You buy those things on market pullbacks. You don't buy those things while the market is pumping. Market will always pull back. You might feel like you missed a good entry, but very oftentimes it will come back to you. However, the difference with shares, and we discussed this actually, I think my last lecture, maybe two lectures ago, so I'm not going to get into too much detail, was all on long-term investment. And it was discussing these kinds of things of, is it a position that you aren't selling, you're only adding to, so you wait for reasons to buy? It doesn't matter if you're scalping, day trading, swing trading, or full on investing. Waiting to buy, letting the market give you a reason to buy is many times going to be the best bet. Is there going to be situations like Nvidia? We can, let's see, what if I got a blank one? Is there going to be a situation, like Nvidia, where you just have this parabolic run and you feel like, well, this was a nice pullback. You feel like you're never going to get a pullback and you do just have to get in there. Absolutely. There is times, more often than not, you're going to get a reasonable enough pullback to start a position. It's still entry is everything. I mean, this is one that I'm in here, Oscar, I think everybody's in here, people were piling into this thing long above 20. And I just look at this chart and to me, there is not, you can even see, I've talked about this in another class. To me, there is not a worse place where you could have been putting on a long position on Oscar than 2220 to 2320 zone. If we get the breakout and keep going, you can look for a better entry, but still let the charts give you a reason to buy. So we look up here and we do this exact same thing, build the trade plan. Okay, I don't want to be a buyer here. I know that. Where do I want to be a buyer? Anywhere from 12 to 14. This is where you buy. This is where, if anything, you trim or sell. And so that's what I always encourage. Doesn't matter, doesn't matter scalp, swing, day trade. Of course, on a swing or share buys, you can look at much bigger picture. Whereas on a scalp, maybe you're only looking at a range that's been going on for 45 minutes, and that's what you're basing your decision on. So Joshua, because you're trading, oh look, Crash said it. You're trading your P&L. I'll tell you what, me and Trader Tom, he is a man that you should do as he says and not as he does. When he sits down to trade, he makes some questionable decisions, at least from the videos that I've seen and all of that stuff. When he teaches trading psychology and all that stuff, it's amazing. But he teaches adding to winners and stuff. I've watched him average up so much that he takes a loss on a massively winning position. So we you can let your winners run. You can set your stop at break even if you want. Absolutely. I'm here to make money. I'm here to book money. And I say this all the time, give me 4 or 5 20% trades or 30% trades to 100% trade that I have to sit and watch it go green, red, and watch it all day long. Don't get me wrong, I'll let swings work a little bit more. But if we're day trading or scalping, we want to be right. We want to be right quickly, and we want to book our money. Amazon's a great one. We can use this. If you buy, this or this or this or this, all of these touches down here, you make so much more money than the person who held for the one nice breakout. That if they didn't have the stop set, they ended up getting stopped out, where you sold. These are short expiration contracts, all of that. There's a million reasons. The person who buys these dips is making much more money than the person who's holding for longer. There's even really famous trader out there, Paul Tudor Jones. He says your first sell is often your best sell. You should be booking those profits. You should hold those things. Could you have held these Amazons and got chopped around all day? Sure. Or you could have taken an entry, taken another entry, contracts likely cheaper than they were here. Again, booking profit is always going to help. Exactly. Kevin does. And going back to stop outs, you respect your stop no matter what. And that's the same thing as this. I would rather stop out for like 10%, watch them go down 20% and take the same buy. I did it today on SPY, just as an example. So I tried, and this was in pro. I tried to catch the bounce off of this wedge right here. My original plan was to hold a little bit lower. Well, ultimately, I took the really tight stop out. I don't know, $4 or something like that. Then these things went down 30%. We sold down to my level. We bounced my level. Is this one? Oh yeah, we bounced my level, and I got right back in. $58, cheaper than I got. Made the money back plus some on one candle. Called it. I will always stop out with a tight stop out and look for reentry. The lecture, it should be recorded. It was from last week. I love Crashmas. Thank you. I appreciate your help. He's answering you guys. Yeah, I think that's a great thing to do. And you when you're trading, larger positions or you're trading shares, like you said, you're trading shares, you let those work more. Like, you aren't buying SPY shares at 634.53 and stopping at 634.42. That is a very short logic. That's short view. When you own shares, rarely is it going to be a straight up situation. So you do like you did. You buy where you plan to buy. Even if it dips down a little bit lower, you always want to leave room to add on shares anywhere you want or anywhere you can. And you hold those positions and you let those positions work. So, like you said, you're in meta at 579 and it goes up 5%, 10%. You aren't going to stop out on a couple few percent pullback, even a 5% pullback. You let those kinds of trades work. Options, very different. You take your entry, you take your stop out, you take your take profit, and all of those are a very reasonable thing. Tight stops, reasonable targets. You don't want to be the person buying SPY calls at 634 saying, do you think it's going to 638? Because I'll tell you what, everybody's making fun of you behind your back if you're that guy. You want to, okay, we're buying SPY calls off of this wedge. We're looking for 635.15, nice scalp into end of day. That's all we're looking for. If it keeps going, whatever, no big deal. Buy the next dip and make a little bit, or short this wedge up here and make some money down. That's what we did into close. But when we're day trading and scalping, a couple extra trades for smaller gains will likely make you lose less money and panic less on your trades. So Crash, really good question. How much of my position am I trimming is 100% dependent on the asset that I am trading. If you know Amazon, this trade that we took, we got my move. Like we got the move that I was looking for in this one candle. I took most of them off. And I don't actually even remember it. I could look at what time we bought these. But maybe we bought this one, and maybe this is actually the one that stopped me out. I don't remember. Give me one second. I'll look just for fun. Let's see. I took a lot of trades today, apparently. Let's see. Amazon calls purchased at. Oh yeah, it says at bottom at 702. So we bought this wick. I got stopped out by this. My target was VWAP. I took most of them off. I ratcheted that stop up real tight. I think we were up 40% or something, 30% on this like bounce right here, so we were happy. So I ratcheted it up. Ultimately got stopped out on the tight stop. On something like SPY, first trim is going to be half of it. No questions asked. Second trim is going to be 3/4 of what I got left, and I'm going to hold on to one or two. And that's it. On a day trade, it's going to be or day trade or swing trade, it's generally going to be closer to like maybe 20-25% of the position on the first trim. And then second trim is going to be substantial, half of what I got left, and then kind of just stick with a couple runners from there. Yep, Kevin, exactly. That's exactly what you want to do. Yeah, see, and Ike, that's where this gets very tricky and the trade plan becomes important. So on something like Amazon with the data expiration, Delta is going to be relatively accurate. So when we know where we want to be dip buyers, and then it sets up for us, and we know where our stop is, we get to go to those contracts that we bought, look at the Delta, I think it's 28 or something like that, and say, okay, we are going to lose about 66% of the Delta, which is going to be $18. We're going to lose $18 off of those contracts. we know we're risking $18 and we're doing it based on something, things technical on the chart. When you start just setting stops based on percentage, you start to stop out of your whole port because there's times and places where holding a little longer makes sense. I'm not If it happens on all of your trades, then you very likely need help on the entries. And so set your stops based on something on the chart and then understand how much that risk is before you take the trade. So again, I want to go back to this Amazon trade that we took and explain something because I was asked this question. And this is funny because I said sometimes people will ask me a question and I'll tell them no, and then they'll end up making money. And so this was one of them. So this Amazon trade hits, and then somebody in voice chat says, "Was it too late to get in?" And I say to them, I'm like, "Well, I mean, yeah. Like I've not only trimmed for nice profit, but now I've also stopped out of the trade. So like I'm out of that trade. So it's too late to chase." And so what they were doing was they were looking to buy above this VWAP and buy at resistance. And we had just taken our whatever it was. I think these things are like $55. I think we sold them at 70, so 20 or 25%. Well, he wanted to buy here. And he did buy here, unfortunately. And then there's here or whatever it was. And then I stop out. They're red. Stay likely red for these two candles, maybe go a buck or two green, and then finally get the one pop where they make money. Well, the other issue with this is they're trying to buy this breakout. For me, the reason that I say no is that, as always with me, it's trade plan. So my trade plan, if I were to buy calls right here, is no different because this was my ideal entry. Well, that means my stop still needs to be down below these wicks, 222.50 or whatever it is. Well, if you're buying at 221.65, all of a sudden you got $1.15 of risk on this trade. And then, I mean, what are you looking for? Maybe a pop up to here. So you get 80 cents of upside. So you have more risk than reward on this trade. So that's why entry is everything. However, if you take the nice entry here, you do want to stick with the trade because, like I said, I just bumped it up. I got stopped out for, 20% or whatever it was. I just wanted a quick scalp. We were ranging. We're at the top of the range. I exit the trade. That was the plan, was to get up here. Maybe you hold it a little longer and you can catch this nice pop. Well, this entry gives the chasers, like the guy who is buying here, it gives the chasers, they funnel your push. They're looking for the move upside that ultimately gets smacked down after one candle. Your entry was so good that you've like trimmed. Your trim is what you have sold to the chasers, and then you make much more money. So there's no reason to chase. And then again, you just sit and wait for that same setup to come back to you. Even this one holds it, holds it, holds it again. Plenty of reasons to get into this trade. Again, targeting VWAP, targeting any of these previous resistances from before, and you catch this nice move up. You trim, and this is what I expected to happen here. That's why the stop was tight. It was the time where it pushed above, but I expected it to sell right back down and continue range trading. So when we build our plans and you build a plan like this, it becomes very, very easy to identify your risk, to identify your reward, and take these trades and make more money with less. What I always encourage people is, you know, 80% of being a trader. And I said this to Dan Boyce, 80% of being a trader, at least being a good trader, is doing absolutely nothing. You sit and you wait and you let the trade come to you. The chasers are like, I'm sure there's people today. Amazon's breaking out. It's going to go set new high a day. I am like 99% sure that somebody in OOT bought Amazon calls right here today. I'm like 80% sure that somebody probably bought Amazon calls right here today. Those don't provide good entries. Chasing very rarely works. Buying dips on relatively strong markets, blah, blah, blah. It works more often than not. Maybe you don't get a massive explosion, but you do get a nice tradable move to the upside. And this all comes back to your trade plan. And so this is scalps, day trades, any of it. So Any questions there? Everybody see what I do? As always, my trading's simple. We look at the daily time frame. That's what we did on Amazon. We look at the daily time frame. We say to ourselves, where do we want to be a dip buyer? Pretty dang obvious. We already had these levels. Now we sit and we wait for those levels to show up and we trade them. We know where we want to enter, we know where we don't want to enter, and we know where we want to stop out. So everybody get it? Again, it's pretty simple. Trade plans they should be super, super simple, easy to follow, easy to understand. Does everybody get that side of it? Okay, perfect. So now we're going to talk about something that's a little bit different. Okay. SPY, and specifically SPY same days. I touched on this trade a little bit earlier. Oh, I did have one more trade. We're going to do something before we do SPY. So we're going to talk about a trade that I didn't take that I massively regretted taking or not taking. Okay, so Hood. I know everybody loves trading Hood. I just got a few levels, a few fibs up here. Showing some weakness, massive triple top on the daily. We know about, and I don't have this level on here. Hood's pretty dang volatile, but we know, right about where we don't really want to be looking long. We don't want to be looking long into this massive resistance that, like, when we get above it, we rip. When we get below it, we dump. We know that 108.50, really 108 up, terrible place to be long on Hood. So now this is a little bit more of a price action trade. So we were watching Hood and somebody brings it up to me. And this is going on. And so for anybody who doesn't know, I love to trade a 3-push wedge. It's a super simple idea. We're actually going to touch on one. This is a reversal to the downside version. The one we're going to talk on the next one is a reversal to the upside version. So right here, somebody brings up Hood to me and it's rejecting. And they like 3-push wedges. They said, is that a 3-push wedge? And I said to them, no, but it's going to, I was like, I think we're probably going to get a pullback. But then when it pushes back up, we know around 108, we don't want to be long. If it pushes us back up into this 3-push wedge, I want to be, that's where I want to be short. And then for anybody who knows, and don't go trade these tomorrow if you don't know how to trade them, but when I trade a wedge top or bottom like this, I like one of these legs to kind of get a little outside of it if I can, as a final push by either the bulls or the bears. So again, we push back up, opening range, our 108 zone. We know where we don't want to be long. We want to be short anywhere up here, as close to 108.50 really as we can get. We want to be short. So we'll just say 108. We enter right at 108. We know that our stop is give or take 50 cents overhead. No big deal. Next major target, about $1 under us. So we already got a 1 risk 2 reward trade. Best case scenario, we want to see it get down to this VWAP. And all of a sudden, we have basically $2 of downside for 50 cents of upside. This is an easy one, no brainer to get short on. That ultimately works perfectly in a couple of candles. Then, if you were to hold, you ultimately get a lot more down. So, this is the trade that I wanted to use. And again, I unfortunately did not take this trade. I'm bummed I missed it. We called this push up to 108 and the rejection when we were back here at 106.80. I unfortunately just got my eyes off of it. So I wanted to touch on how do you manage a trade once you're in it? Once the trade has really worked for you, you've trimmed down, you've got runners. You don't just want to set the stop at break even because you have to have a plan. You can't just say, "Oh, it stops at break even, let it run." Like I hate it when people say that. That's basically saying that like I'm not looking at the chart, I'm seeing what happens. And there is no worse reason to hold a contract unless it's like a total freebie runner to see what happens. That's not trading. So what I encourage people to do, you catch this nice breakdown, you've trimmed some here and there, you've seen it bounce back up, you probably get a little bit worried, and then you start seeing it down. Well, now you can say to yourself, okay, the market has set a lower a high. We had a higher high, higher high, higher high. This is the market's first lower high. This now becomes our stop. And you could even just use the top of this candle, which we're going to get into, and maybe you would have got stopped out, maybe not, but it keeps selling. So now what I look for is what I describe as breakdown or breakout candles. And none of these candles do anything. This is all, these are, I mean, don't get me wrong, I know sticklers, there's some wicks below this bottom. This is a whole bunch of inside candles. Here's your first candle that's kind of closing outside of this candle, and then you get another breakdown. This is where your stop moves to. This is the top of the breakdown candle. This is where your stop sits and you do not move it. You get another breakdown, you get another push up, ultimately another lower high with a nice another breakdown candle. So you're going to move your stop to here. Nice breakdown candle. Again, more consolidation, nice breakdown candle. This is where your stop moves to. This is letting the chart and letting price action tell you what to do, not your feelings, not none of that. Again, nice breakdown candle. I would hope at this point that you're probably you should be ratcheting your stops up a little bit tighter. Regardless, even if you end up holding for this whole, buck bounce against you, you still are going to end up getting stopped out at this area. And you still were able to capitalize on, just over a $2 move to the downside. So let the charts tell you what to do. This is not a very effective method on same days, obviously, due to volatility. If this is a same day and this sells down and this bounces back up, even if your stop had been set around this area this much time and this big of a bounce, you are getting stopped out here. So it's a little bit more difficult with, same days. But again, this is something where you catch a nice breakdown candle to your level, you sell your same days and you short the next bounce and do it again. That's going to be the safer, smarter way to go about it. But you let the chart tell you what to do. Yeah, that is to me, you can't plan a trade without having a very basic understanding of charting. You don't need a lot. What you need is patience. If you have too many levels on your charts where you just don't even know what's going on, you're gonna have a ton of trouble with entries. If you got something like this, like you can see on HUD, I got a few fibs, big zones between them. They of course aren't always going to move between them. You can see this one made it about halfway, not all the way down. But you just need a few important levels, and that is it. Avenger, great question. So it depends on the trade and it depends on what you're doing. A lot of the time, I will wait for a candle to close. Um, but there's times and there's places, without a doubt, we did one today where I bought right in the middle of the candle because I felt, for whatever reasons I was watching at the time, it's going to be the next trade we talk about. For whatever reasons I was watching at the time, it made sense to me. Um, the setup to me made sense. And so, I will say 9 times out of 10, you're better off waiting for the candle to close. As we all know, as we've all seen, anybody who's watched some intraday candles, generally speaking, a little bit of craziness goes on in the last like 15 seconds of a candle where you can be like, okay, I should buy, I should buy, I should buy. And then in the last 15 seconds, you are like, oh wow, I'm so happy I didn't buy. They crushed it, or whatever it is. So I will say most of the time you're waiting for a candle to close. Amazon this morning, as it was somewhere around here. What did I say? 702. I mean, so I probably saw this wick down, maybe saw the buy back up and bought somewhere right around this level, knowing where my stop was going to be. So actually, that one was a mid candle. Could have just bought this close, but I probably waited a second, bought it after that. But on this next trade that we're going to talk about, next two trades. And I'm happy you're in here, Avenger, because I believe you're in both of these trades with me. So as I said, 3 push wedge. And on HUD, we'll just go back to it to show you. You can see 1 leg up, 2 leg up, 3 leg up, reasonable enough short. This is a trade we like to look for. Even if we zoom out a little bit more, this was also super sick. The double top on it was really a no-brainer short here. Nice reversal pattern. We trade against the trend there. Well, on SPY, that happened today. We had nice push down. We had our first leg down. We had our second leg down. This was really kind of our third leg right here, which, paid you some money. Well, we tried to buy this one. Me and Avenger both did. And I took the trade and it was on Pro Trade Floor and I told where my stop was. Well, when I started to see selling below here, I took this stop out right here. These are same days. I don't know what the contracts did, but I'm sure that if I held this contract from here all the way down to here, I was likely down 40, 50% in a couple few candles on a what 30, 40 cent move. You need to admit that you are wrong. Even this candle closing down here, yes, I know it has a wick on the bottom and blah, blah, blah. Even this candle close right here, you take the stop out. No questions asked. However, you might remember when I mentioned three push wedges, I do like when an overextension happens. So when that overextension happens, and we're selling down, I like to look to buy if these buyers start showing up. And so for me, this is again, this is why we're talking in this lecture. I saw us sell down to a very strong level. I saw us kind of set, a little lower low double bottom situation right here. I had an overextension past the trend. And then we also had Apple, Amazon, Microsoft, I believe, all sitting on bounce spots. So plenty of reason to be looking long. When this candle started buying up and when I saw us get above the opening price of this candle, and then I was using volume, 100% buyers. Even after this wick down, we went 100% buyer. Right around here is where I entered. My very first trim, and I think we bought these at 58 bucks. I think you got in a little bit higher than me. I think you bought these, or we got these around 58 bucks. First trim was 68. It was this wick right here. At this point, I'm looking for the low of this range. That's all I'm looking for. And uh we got this pop up. I'm out of this trade. 85 bucks right here. I mean, I took the stop out and I think originally we bought these for 65, maybe something like that. And I stopped out at 55. Well, ultimately I got to buy them down here at 58 bucks. I know higher than I stopped out at. This little bounce covered my little loss on those. First trim covered the loss, got me in profits overall from those two trades, and then ultimately paid a nice little profit on the move the rest of the way up. So that is why I trade same days, super strict. If you cannot follow strict rules, if you cannot stop out where you're supposed to stop out, wait to enter where you're supposed to enter, all of that stuff, you will have a very, very difficult time trading same days. And so, you know, to bring it all the way back to your question, Avenger, there's times and places to do both. There is times to enter mid candle. There is times to just wait and let that candle close. One earlier in the day, I swear in voice chat, maybe it was like some QQQs, I think. So this one, saw it push below. They started buying it up. They got us back above the trend. And I said, okay, I'm going to let this candle close. Well, you can see what happened by me waiting for that candle to close. We didn't get to catch it. So this was one where I did wait early in the day. No denied a bunch of touches on this wedge. Strong buying was going on, but I wasn't quite ready to just, dive in there yet. So this was one where I waited for the candle to close. And ultimately I was never given an entry because it was $2 higher or whatever it was. Okay, so with that, uh, that's all I got. That's all I want to talk about. Again, let your levels come to you. Set your entries, set your stop outs. If profits come, awesome. You always want to have a plan where you want to sell. We always get asked, oh, how do I hold trades longer? We talked a little bit about how I use the chart to hold trades longer using, big breakouts, big breakout or breakdown candles. And you you trade your charts, know your risk, know your profit targets, and you're going to be set. It will make your life much easier, much less stressful. So any questions, anything about that?
Hey, River.
Yep, how's it going?
All right. Hey, what do you consider a tight stop versus just your go-to, your average stop?
Well, a tight stop is something like I did on this SPY. Um, Super tight stop. Let me just look so I can because I want to be somewhat accurate. Let's see. So I bought these. Um, Maybe we'll see if I can find it. Oh yeah, okay. So there's our conversation. Let's see. So we bought, oh wait, that was the first one. Oh, and then so we were discussing buying this candle here, if we close at the opening range. Um, and then I said stops around 58 to 60 on those 635s. And that's what I said. We bought them right here. I believe it was right here. And so we bought them right around here. Oh yeah, this is probably one of these candles. Bottom right around here. And then I said, didn't love the close on QQQs. And so we bought it. And then I had said, my stop was 58 to 60. And shortly after that, I say, might regret it, but going to take the stop here at 66. We bought those at $68 and I stopped out at 66 because I didn't like what the candles were doing. So I took the stop. That is a very tight stop, like a $2 or $3 loss, whatever it was, no big deal. So we took the stop very, very tight. Something that is just a normal stop is like this one on the Amazon. We know we're trying to buy here. Our stops are, worst case 220.50 break of these wicks. That's a nice technical stop, just based on the chart exactly. When I'm going real tight stops, then I'm gonna make a decision. This might not be good advice, but in the moment and say, hey, I'm seeing enough things that I don't like right now that I'm stopping out right now, taking the 3% loss or whatever it is.
Okay, cool.
Yep.
I was using brackets in Active Trader.
Uh-huh. Like OCOs and things.
Yeah, just to kind of set my stops when I enter the trade.
Uh-huh.
But I was
So
using percentages.
they're hard for me because I will say our stop is right here. And we'll talk about this a little bit because it kind of goes along with the trade plan. Everybody should have two stops in mind. You should have your stop loss. And the stop on this Amazon trade was going to be a 5-minute candle close under here. We're buying based on these 5-minute candles, so your stop should realistically be based on those candles. So we get the 5-minute candle close under here. We're stopping out. Well, you also need to have what I describe as the oh shit stop. It's like everything has gone too far against you. You have to exit the trade. You're wrong. You've already lost a little bit more money than your plan stop. So you exit the trade, right? Or, maybe it bounces. Who cares? You have to exit. I'm going to have a hard stop somewhere down here below my 220.20 zone. So a little more risk, 20 cents more risk, but I know if we're crushing below this level, it's time to abort mission on this trade. I'm dead wrong and I bought the wrong knife and I'm getting wrecked. This is going to be, you're going to want to let those candle close and see what happens. If you have a hard stop, like you can see, if you bought this and you had your stop set, below here, very good chance this wick is stopping you out on a trade that you should not have been stopped out of. So I personally make zero use of OCOs. I will say I get to sit and look at the charts the whole time I'm in a trade. So I have more ability than somebody who's working or just has other things going on in life to watch the charts and make those decisions. So OCOs are very powerful or any sort of bracket order, but you likely want to widen your stop a few bucks past where you think the stop is supposed to be so that a wick that shouldn't stop you out doesn't stop you out.
Thanks, man.
Yep, no problem. How do you know if it's the third leg push? Well, you get blown out. So we'll go back to Hood. So, and again, not a trade I took. Super easy to hindsight trade. Do not get me wrong. You got the 3-push wedge. You can try to short this thing mid candle, you might run into a situation, just to go back, like SPY, where you actually get a couple candles below it before the buyers show up. That can happen, you can always get faked out. Or the best way that you could trade this is you short on this close back around this trend or even the little break under the trend, wick back up to it, and your stop is up here. So you still just have to admit you're wrong. That's all there is to it. When you're wrong, you're wrong. And we can say, okay, 3-push wedge. Okay, we definitely got a reversal candle going on here where bears for the first time really all day have taken full control of this candle. So you take the short here and your stop is above it. Using the chart to tell you what to do.
Hey, River.
How's it going?
Good. So just following up with that question, can you go back to SPY?
Yep.
So, like, I've been following your, three push wedge and all that stuff, and I'm starting to kind of understand them. But like, for example, like the top, I see that's the top side, three push wedge, and then you know how it kind of
So,
peaks out. So that still aligns with what I've been kind of like learning from you. But
yes.
that bottom one, I definitely, to be honest, I wouldn't personally have like thought that's a push because it broke under. There's a whole candle that started as like a break and retest, and then like that other. So that's what I'm trying to figure out. How did you like know that that was a buy and it was part of a three push wedge from the bottom? Because you know what I mean, like all
Always.
the examples are like they peak out maybe, but that one had a whole candle. You know what I mean?
So it's tough, uh, because two candles outside of them, I'm going to tell you right now, is not uncommon. Um, Something that you can always do is something like this. So, what is a breakdown on this time frame? No denying it, you know. Did I take the early entry on this? Absolutely. However, I saw this sell to what I thought was a very big level. If we go to yesterday, look at the absolute explosion we took off of this level. We bounced off of it, and then send me a DM, and I'm gonna send you a conversation I had with somebody else today because we discussed this exact trade. So then we look at this and we say, okay, this is two breakdown candles without a doubt. You know, where we view these as some breakdown candles. Well, now if we go to our 15-minute time frame, suddenly this is a beautiful reversal candle. That I will say, you know, Al Brooks, who teaches these things, and I had, oops, not the 1 minute, I had this discussion with somebody today. To Al Brooks, this is going to be your entry. Right here is going to be your entry. The breakdown is coming. Now you get your signal candle, and then you look for the push up from there. Al Brooks trades futures. You have a bit more defined risk. So if you were trading this on futures, you got 4 points at risk or whatever it is, you know. On options, same days, this late in the day, you got a bit more risk. This is a reasonable buy on futures. You're buying 634.30 and you've got 8 points of upside here, risking 4 points of downside. One risk, two reward trade. Great trade. Then you take the context of the market in, where we know what happened right here yesterday. Not only a big breakdown, but a nice push up as well. And so we always go to context of the market. Then if you still, then so there was a lot going on in this trade. Also, range day, buy low, sell high, always in a range day. And this is a range day. Lower low double bottom. I know a lot of people don't think about them like that. That's another Al Brooks thing. Lower low double bottom. The smarter buy is letting this form, letting this pullback happen and buying it. However, if you still aren't quite seeing it, hit the 15-minute chart and let the 15-minute candle close. And when you look at this, you still have your one leg, you still have your two leg, you still have your three leg that pushes out, and the 15 is a beautiful reversal candle.
Yeah, that looks cleaner. That's what I was like used to. So I guess
Yep.
the time frame, yeah, that helps. Thank you.
Yep. Yep. And I love the question. And you're right. The other thing is when you start trading these wedges in the middle of ranges, it's a little bit risky, but it's just, you know, Al Brooks describes it as, you know, the market likes to move in legs of three. Algos like to work in three. You know, they'll buy once, they'll buy twice. By the third time, do they really want to try to buy again? Probably not, especially if the rejections are coming. So that can be when algos fold or people fold or whatever it is. And this is, if you study the Al Brooks stuff, exhaustion candles. I love an exhaustion candle. He'll sometimes call them a final flag. He'll call them all kinds of different things, you know. But I love looking for this type of reversal setup when we're in a range. We know we have big support. Context of the market supports it. As I recall, I swear, oh yeah, Apple setting higher lows for first time all day. Nice double bottom on Amazon, or even triple bottom on Amazon. We go to our Microsoft. Oh yeah, this really just a big higher low. I don't remember exactly where we were buying, obviously, but somewhere in here. Nice higher low off the lows. Final one I watch is Nvidia. Yeah, I know Nvidia's getting crushed right now. It was likely all right around here. Double bottom on Nvidia. context of the market tells us what to do. I tell people all the time, can you trade SPY and ES and SPX only on technicals? Sure. But when you start letting the things inside of them tell you what to do, these are what move SPY, these are what move QQQ. So you get a setup like this on SPY, and then you have all those other patterns or ideas lining up on all those other names. The risk reward is just there in your favor that you shouldn't be getting short down there. Dude, you'll get it, man. It's just time. Like I said earlier in this, you have to look at the charts. That's the only way you're gonna start feeling comfortable. And then you got to think about us, like in voice chat sometimes, and shit, you like Nando. I mean, everybody, like, dude, when we take a stop out, it sucks. We hate taking stop outs. So we're gonna do everything in our power to give you the best possible trades based on what we have observed sitting and staring at charts. I mean, I've been looking at these things on and off for, I don't even know now, 15, 17 years, something like that, on and off. So for me, it's a little bit easy. I understand that it's difficult for other people. Not everybody is gonna, I don't remember which one it was. Not everybody is gonna look at this chart and say double bottom. They're going to see a downtrend, which is also valid, and they're going to try to short the trends. But I'm going to look at this instantly and say, I mean, even triple bottom. I mean, it couldn't have been more perfect. I'm going to say triple bottom, double bottom, whatever it is. Couldn't pay me to be short here for the same reason. Always with the trade plan, we'll just say this is our level. We know where we buy. Any strong selling below it, even, strong sell below this opening range, we're out. Targets are EMAs. I treat everything the same, previous resistances or whatever it is. I treat everything the same. And so I'm able to just glance at it. I know not everybody can do that yet, but I assure you, if I can do it, you can do it. The best thing to do is just look and say, and like, so the most important thing is support and resistance. Very rarely. So I see that we're getting a little late here. What did I do? What did I type up there? So the thing to remember with support and resistance is that we don't, uh, they're never gonna be perfect. So and I can't say they're never gonna be perfect. I mean, here's an example of perfect double bottom off of the pre-market low. You know, you need to be able to glance at the market, not put too much thought into it, and say, okay, is everything at support? Why would I buy puts when everything in the market is at support? And there's always going to be a weird one, or not always, but there's oftentimes going to be a weird one, or there's going to be a name that's running. And so what I recommend to people is pick 4 big tech names that really move the market. I got Apple, Amazon, Microsoft, Nvidia. Those are what I watch every day. I then add in XLF and XLE. Well, amongst those 6 names, those are what I watch all day long. I'm making this number up completely. Feel free to double check me. You're probably watching 35 to 45% of the S&P by watching 6 charts. So when you got eyes on, a nice 30, 40, 50%, whatever it is of the S&P, you can kind of say, well, these all are at a spot where they should bounce. SPY is going to bounce if all of these bounce. Or if all of those are breaking down, SPY is likely going to break down. Or if they're breaking out, SPY is going to break out. So just pick a few things and say, like, when the whole market is, sitting on support or at resistance, don't be a buyer. Or, don't be a buyer when everything's at resistance. Can something break out? Sure, but it's much more likely that it won't. And so that's what we have to do as traders. And then I can show you, let's see if I can remember how to do this. Let me make sure I'm on the right thing. Yeah, I'm on the right thing. Do you guys still see that? Did I mess anything up? So as far as XLF and XLE, I just have them as little charts on the sidebar. I just have them as little charts on the sidebar on Thinkorswim. And then I have this. And this is what I have. I need to extend my fibs, I know. But this is what I have. This is what I look at. Apple, Amazon, Microsoft, Nvidia. So whenever people ask me about trades, this is what I'm watching, and this is why I give answers. So if we look at all of these, and let's see when we were buying the dip today, and then we'll go to SPY here. So we look at SPY, we got a 3-push wedge. It sold to strongest support. That's at 10:25 a.m. Well, we can start to look at these and say, let's see. Oh yeah, this one's already bouncing. This one's 10:25. We're getting a bounce. 10:25. We've double bottomed and are ripping to the upside. 10:25. Oh yeah, look at that. 10:25. We're setting a higher low in the market. Buyers showing up. I gotta believe 10:25 right here. Nice little triple bottom right there. And there you go. Then you go to your SPY and you say, okay, I'm buying. You know, that's the spot to buy. And that's what I do every single day. Oh yeah, yeah. I meant yeah. And I mentioned that on Avenger. We got stopped out somewhere here and we bought somewhere here. Yeah, that's the way it goes. I won't say that there was like any like I think that this is just, tariffs are kind of catching up to everybody, whether people want to admit it or not. But the main thing to take note of was that like I'm sorry if you were longing Nvidia right here. Like I, I just don't know what to tell you. There was really there just wasn't a worse place to be long on the chart. Did I expect it to crush from 182 all the way down to 168 or whatever it did? No, but we knew that the risk reward right here heavily favored the shorts. So technically speaking, while we didn't necessarily need to expect a breakdown. We should have been pretty dang aware that if we could get a short put on somewhere up here around 183, we were looking for 184.50, as our stop, and targeting $3, $4, $5 down to just, the lows of this consolidation. So technically speaking, there's definitely little to no reason to have been buying Nvidia up here. I don't know what my real chart is. Here's my real chart. I mean, you can see my normal one, and you can see where I would have really been targeting. So just always look at the charts. Nice, love it, Joshua. Love it, love it. And love the questions. Johnny, thank you for the questions. Everybody, thank you for the questions tonight. And I think with that, we will call it. And I will catch you all trading tomorrow. I think I'm in pro in the morning, but I think I'll probably be jumping in premium end of day. So thank you all and have a great rest of your night. Yep. Joshua, Johnny, thank you. Dashmas, thank you. Loved having you here lately. Okay, right on, everyone. Have a good one. Yep, Avenger, I'm sure we'll catch you tomorrow. Thank you.